Hi everyone and welcome to this short recording. In this we'll just summarize the T accounts that we discussed in the PowerPoint and how to make entries when you're making entries in T accounts. So accounts can be classified as assets, as liabilities, as revenues and expenses. So based on what they are classified as, the account structure changes a bit. Okay, so if an account is classified as an asset, anything that is classified an asset, so you have increase whatever entries that increase the account, you will have it on the left hand side, and whatever decrease the account, you will have it on the right hand side. So if you're buying any asset, so let's say I go ahead and buy a laptop. So if you buy a laptop, the increase will come here. If you're selling a laptop, the decrease will come here. Okay, and on the increase side you have opening balance. So let's say I already had a laptop and I added one more. So let's say opening balance was $2,000 and I added 2,000 more. Based on that, you will have closing balance. All the decreases to assets will come on the right hand side. In liabilities, it's reverse. So liabilities increase is on this side and decrease is on this side. So liabilities is loans. So any loans that you take, they will come on the right hand side. Any loans that you repay, it will come on the left hand side. Okay, on this side, decrease side. So opening balance, whatever loans you have, any addition to loans you make will come here. Any decreases to loans you make will come here, and based on that you will have closing balance. Now, common assets that you will incur, like you will encounter as a small business. So you will have accounts receivable. Account receivables are created when you do credit sales. So when you sell something on credit, it becomes an account receivable. Account receivable is an asset. So any account receivables you create, increase is counted in this side, decrease is counted in this side. How does account receivables decrease? When the customers pay you, there is a decrease in account receivables. When you create a credit sale, the account receivable goes up. What are account receivables? Account receivables are credit sale. So let's say I'm selling this iPhone on credit to someone. The moment I make the sale, account receivable will go up. So it will come here. The moment the customer pays that to me, the account receivable will go down and it will come here. Okay. Opening balance is on the left, right, and closing balance is also on this side. Prepaid insurance, if you're making insurance payments and like at the beginning of the month, but you utilize that payment throughout the month, whenever you make those payments, right, then there is increase in prepaid insurance, so it will come on the left hand side. If you utilize those payments, there will be decrease in prepaid insurance. Any equipment you buy, again like laptop, machines, etc., opening balance, all the increases here, all the decreases here, closing balance, we close it. Okay, so equipment. Then drawings are when you take money from your business. So any business, any drawings that you do on, right, opening balance is here, all the entries will come here and decreases will come on this side. So all assets, effectively, increase in any asset will come here, decrease in any asset will come here. Opening balance is always on the increase side, closing balance is always on the increase side. So account receivable going up, you'll make entries here. Account receivable going down, you'll make entries here, right? Opening balance plus increases minus decreases gives you closing balance. So opening balance, let's say $1,000 you have, $200 you increased, then $300 you increased. Okay, this is, we always number them. So one for first entry, second entry, let's say the third entry was decrease of 200. So the closing balance is always calculated as opening balance plus the increases minus the decrease. So opening balance 1,000, you made some transactions, some of them increased it, some of it decreased it, closing balance 1300. That's how you do it. Okay, liabilities side, it is reverse of this. So common liabilities that you will encounter: unearned revenue, right? So this is an liability. Okay, unearned revenue becomes a liability. Well, customer is paying you before, but you haven't delivered the product. So any increase in that will come on the right hand side, right? Let's say unearned revenue was 1000, opening balance. You again had customers paying you before the delivery, but you also made delivery of 500. Okay, so all increases come here, all decreases come here. Closing balances 1000 plus 200 plus 300 minus 500. So this is how it works. Any increase comes here, any decreases come here. Bank loan, same way. Any bank loan you take, right, you borrow, it will come here. Any bank loan you repay will come here. Opening balance you will have, you add all the increases, you subtract all the decreases, you get closing balance. Capital is also considered like liabilities. So any capital you raise from your shareholders, that will come as capital. Like if owners are putting money into the business, it will increase the capital account. Anything that is being paid back to the owners, it will decrease the capital account. Okay, so capital again. Now revenue. Okay, in incomes, this was balance sheet accounts. All these are balance sheets account. You have either assets or you have liabilities. Assets, opening, closing, increase, decrease. Liabilities, opening, closing, increase and decrease. It's a little different for liabilities. In income statement, you have two accounts basically: revenues and expenses. All revenues, right, they behave like liabilities actually. So you have increase here on the left hand side, decrease here. Okay, so increase on this side, decrease on this side. Opening balance, closing balance. So let's say $1000 of sales you had, you increased sales by 200, 300 and whatever, right? There was a refund of $200. So any decrease will come here, all the increases will come here. Closing balance, opening plus the increases minus the decrease. Okay, expenses, it's other way around. So common expenses that a small business has, you have telephone expenses, insurance, salary expenses, internet expenses, entertainment expenses, maintenance expenses, meal expenses and miscellaneous expenses. All expenses, how will you factor that in? It will have opening balance 300 or let's say 3000. Okay, all the increase in expenses. So you had an opening balance of 3000 for telephone expenses, you did 200 and 300 of expenses. Okay, the closing balance will be opening plus increases minus decrease if any. Decrease is 0 right now, so this will be closing balance. Okay, so this is how accounting works. So in your assignment, you have to figure out what is happening. Okay, all entries have dual entry system. So any entry that you're making will generally have two impacts. So find out which impacts you're having and make the necessary entries in those accounts. Okay. An example for that will be, let's say let's say account receivables. If account receivables are going up, right, you will make entries here in asset side, account receivables, but account receivables are also sales, so revenues. So you will make entry in revenues. Same way, like if let's say prepaid insurance is going up or unearned revenue, let's say unearned revenue is going up, you will make entries here, but you will also factor that entry in revenue. So that is how every entry will have two impacts.